All right, let's dive right into this explainer. We're going to pull back the curtain on the hidden mechanics of the market and figure out exactly why perfectly good trades so often turn into sudden, unexplained losses. If you've ever spent hours analyzing a chart, executed your trade flawlessly, and then just watched the market aggressively spike against you before immediately going your way, well, don't worry, you aren't cursed. But you are in exactly the right place.
You know the feeling, right? It is a universal frustration for retail traders. You set your stop loss, the market comes down, tags you out by a literal pip, and then boom, rockets off in your anticipated direction. It feels personal, like they're watching you specifically. But I'm going to show you that it's absolutely not bad luck. And it's certainly not a coincidence. It's actually by design. The market isn't out to get you personally. It's simply seeking the exact thing it needs to function.
So let's kick things off with Section 1, the retail trading illusion, or as I like to call it, textbook traps. Think about the absolute foundations of textbook retail trading. You've got your trend line bounces, your support and resistance ranges, and of course, equal highs and lows, what we usually call double tops or double bottoms. Now, retail traders are taught from day one that these patterns represent safety and predictability. But what they actually represent in reality, they're massive, flashing neon target signs for institutional algorithms.
Moving right along to Section 2, the reality of smart money, manufacturing a reason to buy.
Okay, we really need to talk about liquidity because this is absolutely crucial. See, you and I, as average retail traders, we can hit buy or sell at virtually any price because our order size is just a drop in the ocean. But the big players, the large institutions, they literally cannot operate this way. They control massive, massive pools of money. If they want to buy huge quantities of an asset, they need an equally massive amount of sellers on the other side of that trade to fill their orders without totally crashing the price. In other words, they desperately need liquidity, which means they literally have to manufacture a reason to buy or sell.
It all boils down to a super deliberate three-step playbook, engineered to turn retail losses into institutional fuel. Step 1, retail traders place their obvious stop losses right behind those textbook patterns we just talked about. Step 2, institutions temporarily push the price to trigger those stops. And Step 3, as those stop losses convert into live market orders, the institutions absorb that newly triggered liquidity. They use it to quietly fill their massive positions and fuel the real, intended market move.
Let's look at the evidence. Section 3. Evidence Room 1. The Trendline Trap.
When you see a completely flawless descending trend line, where the candle wicks just kiss the line perfectly, it looks like the holy grail, right? Clean lower lows, clean lower highs. The most beautiful downtrend you could ask for. But remember, this isn't a coincidence. Institutions know that retail traders are constantly scanning the charts for these exact sorts of setups. This perfect trend line is deliberate bait. It's there to entice retail sellers into the market.
So you get that textbook rejection on the third tap of the trend line, complete with a nice little retracement candle. Retail traders confidently jump all over it, going short. And where do they put their stop losses? Exactly where the textbook says, safely above the previous high and just above the trend line. They think they're riding the trend, but really all they are doing is pooling their liquidity together in a highly visible zone.
And then, snap, the trap springs shut. Price just slices right up through that trend line and breaks that previous high. Now, what does this actually accomplish? First off, it grabs all that stop-loss liquidity from the early sellers. But second, it also triggers the buy stops of breakout traders who suddenly think, oh, a new uptrend is starting. By triggering the stop-loss buyers and the breakout buyers at the exact same time, smart money gathers all the fuel it needs. Once their massive sell orders are filled against that surge of retail buying pressure, the market aggressively dumps to a new low.
So I really want you to lock this concept into your brain every time you look at a chart. What textbook traders eagerly call a breakout is way more often than not just smart money running the stops to fill their own orders. They are hunting the liquidity that you provide when your stop loss gets hit.
Next up, Section 4, Evidence Room 2, Support and Resistance Sweeps.
We all know the drill here. Retail traders are universally taught to buy at support and sell at resistance. Because everyone is following the exact same rulebook, massive pools of liquidity naturally build up just outside these boundaries. You've got buy stops sitting above resistance and sell stops resting beneath support. It essentially creates a tightly bound box of money just waiting to be tapped into.
Watch what happens during a sweep like this. We have a clear resistance cell where sellers got involved. Then price just pokes its head above that resistance line, just enough to trigger those seller stop losses. And remember, a short seller stop loss is a buy order.
With that fresh liquidity absorbed by the institutions, look at the reaction. The very next two momentum candles aggressively drop. Seriously, those two candles cover a downward distance equal to the entire previous trading range? Why? Because the institutions finally had the liquidity they needed to actually make their move.
The big takeaway here is that price doesn't just wander around aimlessly. It actively seeks out dense clusters of liquidity. There is liquidity resting at every significant high and low in the market. And institutional algorithms are literally designed to maneuver the price toward these exact zones to get their large orders filled. Which brings us to Section 5, Evidence Room 3, Equal Highs and Lows. You know the famous W pattern, right? That pristine, theoretical double bottom taught in every beginner's guide. It always looks so perfect. But contrast that clean theory with the brutal reality of a live chart. The market will establish those equal lows, convincing retail traders that it's a rock-solid floor. Then price deliberately drives a sharp wick right below those lows, strictly to grab the resting stop-loss liquidity. It's only after that sweep happens that the true reversal upward actually begins.
And it's the exact same story on the flip side with equal highs. Notice how price will just slowly, almost lazily, creep up to sweep these highs. This upward movement doesn't have any strong momentum. It's just a series of corrective, low-momentum candles. This move exists solely to take the liquidity resting above those highs and mitigate a higher timeframe order block, which, by the way, is just a fancy way of saying institutions are closing out their old positions and opening new shorts before finally breaking structure to the downside.
All right, let's bring it all together. Section 6, the takeaway, trading with smart money.
If you take nothing else away from this explainer, remember this. Your stop loss is quite literally the fuel that powers institutional trades. Once you realize that trend lines are often designed to trap early entries, that support and resistance ranges are just hunting grounds, and that double tops and bottoms are massive targets, well, your entire strategy can change. If you can identify exactly where textbook traders are hiding their stops, you can simply wait. Just wait for the inevitable liquidity sweep to happen first, and then trade alongside the institutions instead of getting crushed by them.
So I'll leave you with this to chew on as we wrap up. The next time you're staring at a chart and you see an absolutely flawless textbook setup perfectly aligning right in front of you, take a step back. Ask yourself, who is actually benefiting from this trade? Are you about to ride the trend, or are you just about to provide liquidity for the smart money? Keep your eyes open, wait for the sweep, and trade smart.